Hello and welcome to the CRE Playbook, your weekly spot for deals, strategies, and tactics to improve your game. I'm your host, Carl Krauskopf, and let's start off with a quick story. When I was a child, I'd frequently go fishing with my father and my uncle. No matter what the weather was, we would always go out. My uncle had a 15-foot Carolina skiff, which was a tiny, tiny boat meant for flat water fishing, right? So no waves, no wind. But there was this one particular memory that I remember where we, again, didn't check the weather, didn't go through with our normal planning. And we get out there, and the waves were double overhead right as we get past the inner waterway. And so I started getting sick. It was awful. We immediately turned back. And what does this mean? Right? It's needless to say, we turned around, like I said, and we were just poorly prepared. Just like that, as a mariner, skilled mariners read tides, right? They read the tides, they read the weather, they understand what's happening meteorologically, and they know in order to have a successful fishing trip or a successful charter, they need to be able to properly prepare. Just just as a mariner, investors need to do the same. And so we need to analyze the market trends, the global economy, the local economy, the macro economy. We really need to be making sure that we know exactly what's happening and how it plays in our space. So that way we can make adjustments to our investment strategy or completely change them, as I have in the past. And that is how I've explained in the past, right? Where I was building, I was selling, I was flipping, and it was all well and good because we were getting out in 6 to 12 months. But now it's radically different. We don't know what's going to happen in 6 to 12 months. And so I adjusted my investment strategy to have a broader outlook, to have a broader horizon. So that way, again, we can weather the storm. We have the necessary tools to weather the storm. And that is what I want to talk about today is how I'm preparing myself, my company, my team for the 2024 and out years from there. And again, in both scenarios, preparedness and adaptability are absolutely critical to capitalizing on those opportunities. So before I do go into any details, I want to say two things. Happy Thanksgiving to everybody. Really want to take some time here to mention what I'm grateful for. I'm grateful for the folks around me, for my wife, my family, and everybody who's made a huge impact on me, right? From mentors all the way to partners, to investors, to clients who have really believed in our story and enabled us to continue growing. And so, again, I thank everybody out there. I thank you too for listening. I think the tenants that occupy our buildings. I thank the partners, or rather the contractors that we work with in the real estate space. So again, thank you so much to everybody who's made a critical impact on my life. Secondarily, before we go into the details of the actual outlook, I want to make a quick mention on my resources and what governs my investment outlook. Right? What is the wind behind my sails? What's really governing, and what am I looking at in order to make my near term and long term investment decisions? And I would, if you're actively investing, if you're passively investing, I would highly recommend that you ask your team this, right? What are you watching? What are you learning? What are you reading in order to make your investment decision? So I will drop these in the comments, the show notes, so that way you can access them as well. And let's go through those. So first and foremost, it's going to be the national. Again, my space is the commercial real estate space, specifically multifamily and residential space. And so, who am I talking to? I'm talking to the people that are in the business, whose job and whose capital, who's earning money from trading these types of assets. And so, who are those? Those are the brokerage shops, the national brokers, real estate brokers, the local real estate brokers, also the mortgage brokers as well. We'll get into the capital market side in a second. But really, again, finding out who are the folks that are doing the biggest and most advantageous, the type of business that you want to be working in, investing in, and really learning from them. What do they think? What do they think that the market's going to be doing? Where do they think values, occupancy, and rent growth is going to be over the next 12, 18, 24 months? So that is one of the first and foremost places that I'm constantly talking to these folks. And again, this is multiple times per week that I'm doing this. Deloitte and other consultants, right? I'm getting macroeconomic updates from them, not only economic but geopolitical and consumer updates, financial updates. Again, this is Deloitte and other consultants, McKinsey, Bain, etc. Investment managers like Blackstone, again, one of the behemoths, especially in the real estate space. From an investment standpoint, those are the folks that I really enjoy following. Seeing what they do really plays into where they think that the market is going to be successful in, and that's where I want to be as well. Financial services like JP Morgan and Chase, really understanding what's happening from the investment banking side. Data aggregators like MarketWatch and newsrooms like Wall Street Journal, business journals. We have one in the Puget Sound, the Puget Sound Business Journal. And then lastly would be nonpartisan think tanks. It's an interesting word. Think tank, essentially a group that really is somewhat similar to a Deloitte, but really this is a targeted approach, nonpartisan, not for profit as well. This company, Milken Institute, really love them. They put on an annual best performing cities list. Really phenomenal. If you don't have that, highly recommend you downloading the copy of that and monitoring it over the coming years. Right, looking at where each of these cities, large and small, primary, secondary, tertiary, move in terms of where Milken Institute thinks that they are going to be positioned from a successful investment city. So again, we are invested in many of the top performing cities, both large and small, here in the state of Washington. And again, I really echo, I really want to recommend that as you invest with others, alongside others, that you are engaging with your operators, engaging with your leadership team, and asking what are they studying in order to define and guide the investment strategy. That is super critical. So on to the 2024 outlook. What I would say, I would paraphrase my feelings about the market outlook as cautiously optimistic. So what does that mean? Somewhat hesitant, but I am building the blocks necessary to jump into really successful multifamily deals. And so those multifamily deals are going to be things where we can get in at such a low cost basis, where we're cash flowing on day one, where we have just about a guaranteed exit because we have a 7-year outlook, because we can trade, we can go out and trade when the market recovers, which we do believe to be in 25, 26, 27, those years to be really fully ramped back up. And so we want to go in, have a low cost basis, cash flow day one, and be able to trade at the right time in the market. And so I want to break into some of the categories of what is defining or how I'm looking at the market outlook. Those are really the first and foremost is going to be inflation. How does inflation impact everything else, right? Inflation is really going to define the Federal Reserve's action plan on increasing, pausing, or decreasing their interest rates. And so really, why is that important? Because why is inflation important? Because again, if it continues to be sticky, if it continues to be high, or if it continues to be a trouble, the Federal Reserve will not decrease or may even increase rates, right? It's still not completely out of the cards, but it is less likely at this point. And so inflation obviously then defines job market. So what happens in the job market is super critical, because job market is going to be employment, unemployment, and that defines vacancies and rent growth. Other ones, obviously capital markets, right? What's the restriction on lending? What's the tightness on credit? Geopolitical, right? We're going to be here in the United States. We're going to see some general election, presidential election in the coming year, and that's going to be huge, right? So how is that going to impact our ability to go in and make these properties perform, and also acquire new properties? And how does the geopolitical landscape impact the capital markets, and how does it impact the Federal Reserve's interest rate? May or may not, but again, this is something that you want to be paying attention to. Lastly would be property performance, right? How are properties performing right now? how are our multifamily properties performing, right? How is rent growth? How is the vacancy? What are we expecting those to do over the next 12 to 18 months? Also, want to talk a little bit about the volatile operating expenses, right? A lot of us have experienced abnormally high operating expenses, specifically just a few to name, we'll get into taxes and insurance. Taxes and insurance have been absolutely astronomical on from a rising perspective. Now, here in the Seattle, Washington market, we have a little bit of insulation there, but a lot of the Sun Belt and other markets we'll talk about have experienced some radically high rate increases. So those are the main levels: inflation, job market, capital markets, as well as how are multifamily or commercial real estate performing, as well as the geopolitical landscape. So let's dive right into inflation. So inflation is expected to continue cooling. However, it is going to start slowing down. It already has, but it is going to continue to slow down even more. Right now, our headline inflation rate is about 3.2%. Core inflation is 3.9%. This is measured on CPI, which is the Consumer Pricing Index, which is one of the top ways that one of the top ones that the Fed looks at in terms of defining and determining what the inflation is. So we have our eye on that. We have our eye on PCE and some other metrics to really define how inflation is trending. We again think it's going to continue cooling, and we're going to get to probably a mid two range by the end of 2024, which puts us right on target in the 2% by 2025, mid year 25. So that's going to be when everything is jiving again, everything's normalized from the Fed's perspective, and they can really start again. Hopefully, we get that soft landing, really get to a spot where interest rates can come back down nominally, inflation is nice and tamed, and there's no massive recession now. The opposite could be true of all of a sudden things start breaking. Banks, credit unions, and regional lenders, they start breaking, their financials start breaking, and then all of a sudden right, we have more episodes like Signature Bank, what happened sometime earlier this year, where these banks start going out of business because there's deposits are being withdrawn at such a rapid rate, they no longer have the liquidity. And so then the Fed is going to have to likely step in one way or another, whether it's bailouts, whether it's radically decreasing interest rates, which sound great, but it's also a double-edged sword, right? If we're quickly decreasing interest rates, something in the system is broken. And if something is broken, it's going to have long-term, really short, very, very painful short-term impacts, but also long-term impacts as well. So our hope is that we see slow interest rate decreases. My expectation is going to be late into 2024, probably into early 2025 is when we'll start seeing the decreases. Some experts do believe that we'll see some rate decreases in 2024, middle of 2024, so probably around the July timeframe. But again, I'm not banking on that. I'm not pricing that into any of my underwriting. And I'm expecting, again, late 2024, early 2025. So going into labor market, one of the other things that the Federal Reserve looks at in terms of decreasing their interest rates is the labor market, right? How strong is the labor market? And that has been the most difficult thing to tame in all of this right now is the strong employment market. Now, we've seen inflation come down pretty radically right over the last 12 months, but we haven't seen the labor market decrease or soften. In the last month, we've seen some softening, but it's still strong, right? Our unemployment rate is still 3.9%. Expectations for 2025 are going to be, or excuse me, for 2024, it's going to be 5%. So that's a 100 basis point increase over the next 12 months. That's pretty big. And so what does this mean as an apartment operator when the unemployment increases? Well, as an apartment operator, we have to price in increased vacancy, increased bad debt, right, delinquencies, and increased expenses relative to evictions. And so we as apartment operators, really need to think about how that vacancy, how that unemployment is going to impact us. So what we're doing is bolstering up operating reserves, so that way we can fend off any decreases in net operating income. So that way we are not in a position to in a distressed position from a financial standpoint. So that is what we are currently and will continue to work on over the next 6 to 9 months. Um, Continuing on beyond the labor market, one thing to mention on labor market is really what I've talked about in the past in past shows is, know your micro economy, know your macro economy, and how they all interplay between each other. From a micro economy standpoint, know the markets that you're investing in. Right, if you're investing in a high tech or high agriculture like what we have, markets is how does this upcoming potential recession impact those types of employment. And from my perspective is from a tech standpoint, depending on where we're at, what your pay is, you can certainly be in a difficult position, especially a lot of them are visa related, visa backed employees. And so you could see higher spikes of vacancies in markets like that. Whereas agriculturally speaking, what could impact agriculture from a employment standpoint. Now, right now, a lot of the experts do think, and when I say experts, I mean large investment managers are buying up farmland and agricultural assets. So, from my perspective, that is a inflation resistant asset, the farmland. Now, those employees that support those types of assets are going to be strong when we are going through recessions. Why? Because again, if our investment managers are focused on buying that type of asset, who's servicing that asset, we are then housing those service workers. So again, I don't expect any major decreases or vacancy spikes in that type of employment. So again, why is it important? Know your microeconomy, know your labor market. Moving on to the capital markets, right? We want to talk about tightened liquidity. We want to talk about credit restriction, and the cost of capital. Obviously, is the big elephant in the room. Cost of capital, right? We've historically, over the last several years, have had radically compressed interest rates where borrowing is easy. It's quick and easy. We can get high leverage, we can get low interest rates, and it's beautiful. But now it's the opposite's true. We have to bring in a lot more capital because the lenders' liquidity is tightened, as well as the cost of capital to borrow it is a lot higher. So to give you an example, right, on a borrowing for an apartment, about a year ago, we could go as high as 80% loan to value from a loan perspective. We were also securing a 4.5% interest rate loan. That was fantastic. Now what we're talking about and looking at is more 70% loan to value. So we have to bring in an extra 10%, right? Which on $1 million property, which we're not trading, $100,000, not too big. But when you're looking at $10 million properties, that's an additional $1 million of private capital that we're having to bring in. And so really, really want to be cognizant about the types of properties you're looking at, making sure that you are accounting for those changes in the credit availability as well as the cost of capital. Now, cost of capital side, right now for the same type of product that we bought a year ago at 4.5 interest rate, we would be buying at 7 7/8 right now. So 7.875, astronomically higher. There's no way that deal would work right now from a cash flow standpoint. So know your deal, know your market, know your capital structure. Absolutely critical. So some things that some operators are doing right now are continuing to what we're doing is bolstering up our capital investment side. So our private investors working and continuing to work with those clients, as well as stacking clients that are bringing in preferred equity. So higher cost of capital, but they do play an absolutely pivotal role typically you'll find those in rescue funds, right, where a property needs to go out and refinance. They can't get any more from the lender, so they go to these private equity shops. This is not what we're looking at them for. But what I'm looking at private equity for, preferred equity would be going in and buying a, a rehab loan or something where we want to go in and do some substantial renovation, substantial value add, and a typical bank would not be able to provide that. So again, preferred equity is something that's out there, and I certainly encourage you to look into it and determine whether or not it's part of your strategy. Geopolitical is the next one up. So we've got a couple things coming up. Globally, like let's look at the global world. Let's look at the national realm, and let's also look locally, right? So geopolitically speaking, we still have two wars going on right now. We've got the war in Russia and Ukraine. We've got the war over in the Middle East with Israel, and additionally, right, we've got tensions rising between China and their neighbors, right? Whether it's China and India from a trade perspective, China and Taiwan, as well as China and Australia, right? That one's a new one to me at least, where they have heightened restrictions or heightened tensions relative to trade. So, what does all of that have to do with us here in the U.S.? It certainly has cost implications, right? So if they start imposing tariffs on each other's trades, and we're getting some of the glass or granite from China, and there's minor improvements made from an Australian fabricator, we could see increased cost of granite. That's an example. I don't think that's actually going to happen with granite. Again, that was an example. Now the other side of it is, looking more locally, is what's happening next year in 2024. It is the presidential election, right? So that's going to be huge. That's going to be huge in the U.S. And how is that going to impact capital markets? How is that going to impact local economies and the macro economy? So certainly you want to keep your eye on what's happening in the presidential election in 2024. So, diving even deeper, looking at the local economy, right? I'm gonna speak for a minute on the city of Seattle for a minute, and I'm gonna cheer because in my opinion, we're celebrating a win. We had, I want to say, it was 6 of 9 positions reelected at the city council level in the city of Seattle, and if you look at all 6 of those newly elected officials, they are all, at least from a campaign standpoint and from a historical standpoint, as well as their endorsements, they're all moderates, right? And so, what does a moderate do for businesses when we're coming out of a hyper progressivism mindset? Is we're going to be shifting back towards a business minded, a business focused, and investment friendly city again. And when coupled, I've been seeing this for the last 3 months. Once we started the general elections earlier this year, I think that this is really going to become a big thing for us. So coupled with the fastest growing large metro, right, Seattle from 22 to 23, continued increasing in terms of rather decrease in supply, we're going to see some great movement here from an investment standpoint in Seattle. So if you're not invested in Seattle, reach out to me. Would love to help you out there. Property. Lastly, let's talk about property performance, right? How is your property performing? How's your multifamily property performing? What are the things to look out for, right? We've talked a little bit about them on the past few topics, but let's dive a little bit deeper. Vacancy and rent growth, foreclosures, as well as the volatile operating expenses. So to hit off on the first one, the impacts of the labor market relative to vacancy and rent growth, right? If we start seeing 100 basis point increase, a full 1% going from 3.9 to 5% unemployment rate, we are certainly going to feel some pain in terms of vacancy. We're going to feel some pain in terms of delinquency, potential eviction expenses. And so you want to be in front of your tenants, having those conversations with them, making sure that there's a two-way communication between if they need help, getting them the help that they need, and or moving them, right? If we can move them into a cheaper unit in-house, great, because we're filling two needs. We're filling a need to get them into filling another unit, right? So getting that vacancy filled, as well as keeping them on a payment schedule that makes sense for them, as well as you'll be seen as working with them as really truly trying to do the right thing in their mind. So highly recommend that you work directly with your tenants to be able to offer them what they need from a housing standpoint. The next one on that realm is, for most of the United States, we're coming into a huge glutton of supply in terms of multifamily over the next, I would say, 18 months. Right, we've historically been on a supply shortage. Right now, we are seeing a lot of new construction units coming online, including Seattle. For Seattle's a little bit different, right? We peaked in terms of new supply coming online about a year ago. So we are going to see the high end start tapering off in 2024. And really in 2025, we're going to see a complete falling off of a cliff in terms of new supply. In other markets, right, Sunbelt specifically, where there's been this huge demand, right, population's growing really fast, so we have to build. But then all of a sudden, people stop moving in, and that all that supply catches up. What's going to happen? Well, what's going to happen is you're going to have an oversupplied market, and so in order to fill those leases, merchant builders, right, people who are building to sell, those merchant builders are going to start cutting rates and offering some insane concessions, which if you're a class B, class C apartment holder, you could see some of your either tenants moving into those class A where it used to be out of reach from a financial standpoint for them, or they're able to get relatively similar rates with highly amenitized apartment units. So again, keep in mind what's happening in your micro economy from a new supply standpoint. Foreclosures, it's already started to happen. We've seen news over the last 6 months, specifically a couple to note in Houston, where I think it was about 3,000 units were taken back by the lender, right? And those 3,000 units were then sold off at loan value or par value, and what happened to that original operator? Terrible, awful, right? They scaled unsustainably in an unsustainable way. They had some other issues going on, operationally speaking, but that lender, right? Unfortunate for them, fortunate for the potentially fortunate for the buyer who acquired those units. So where we are going to see a lot of seller pain, there's also going to be buyer gain. So we are positioning ourselves as an acquirer of assets over the next 12 to 18 months. That's why, again, I said I'm cautiously optimistic about this upcoming cycle. I do think that we will continue to see value decreases over the next 12 months, right, in the tune of 10% potentially, and in some cases even higher, where the seller has to sell because there's distress, right? They can't refinance, and they have to sell. They're either selling for a partial or a complete loss, right? That means it's going to go back to the bank for the loan value. If you can go in as a new buyer and acquire it at loan value, that is huge. That is absolutely phenomenal. Now, there will still be some cases where the lenders will even take a discount off of that loan value. So keep an eye out for what's to come. Get your capital stack, get your capital structure ready, so that way you can go in. This is what we're doing, so that way you can go in and start acquiring. Now, acquire smartly, right? No, and that goes back to knowing your market, knowing your labor market, your capital market, knowing everything about your micro and macro economy. So again, that's why I highly recommend whoever you're investing with is to go out, do your research on the broader market and the micro markets. Lastly, volatile operating expenses. Let's talk about that for a second. Is taxes and insurance have continued to go up. I think specifically insurance. I think everybody's feeling the pain there, right? I've talked to several Texas operators, and their insurance rates used to be in the $500 per unit per year range. Now they're $1,500 per unit per year. Absolutely radically insane, right? And how much further is it going to go? right? Is it continuing to increase at a 20% premium per year? In some markets, yes. It's crazy. Now here in Seattle, we are seeing some increases. That's because most of the insurance companies that we're working with are do have some national accounts and national implications. But for the most part, we are getting our insurance through hyperlocal agents, hyperlocal insurance companies that have a larger book of business here in the state of Washington. Why? Why do I favor that? Because from a natural disaster standpoint, we have relative insulation, right? We've got wind, we've got some landslides, but landslides covered under other policies. So we don't have a lot. We don't have a whole lot of we do have wildfires, but again, we don't have a whole lot of property damage to our multifamily properties right now, residential, commercial at all. So again, I think that we're relatively insulated in the Northwest. Again, taxes always increase for this for high growth areas. We have seen some growth in the Seattle market. We've seen a lot of growth in the taxes in the Sun Belt as well. And then lastly, I would say utilities. I think utilities is the hidden killer of some of these deals, right? Make sure you know what you're doing in terms of your utility expense growth rate, right? A lot of times it's easy just to put a 2 or 3% escalator, but really, if you look back historically, utilities have increased by greater than 5% annually over the last 50 years, excluding the increase that happened during the pandemic, right? The pandemics, we saw some mid-teens, high-teen annual rate increases on the utility expenses, and it's since normalized back to the sub 5% range right now. Now, again, what am I saying here is just make sure you know what you're increasing, what you're inflating your utility costs to. So these trends and forecasts are what govern our decisions of where to push and where to push offense and where to pull on defense. So really want to make sure that you are up to date on your on your macro micro economy, on your geopolitical landscape. Now we're staying focused local. We're focusing like I said, bolstering our reserves on the assets in hand. We're pursuing distressed deals where our cost basis puts us in a positive leverage, right? Where we're cash flowing day one. We're building relationships with private capital investors, institutional investors, preferred equity funds, and debt dealers. Now, I want to thank everybody for joining me on this Thanksgiving Day. If you found this helpful, I would ask that you like, subscribe, comment, share this with 2 people if you found it helpful and if you think that they would find this information helpful. And that is it for today's CRE Playbook, your weekly spot for deals, strategies, and tactics to help improve your game. Thank you all and make it a great day.